Hello everyone, I am Sabresh, Assistant Professor, Department of Management Studies, K.S.Rangasamy College of Technology. Now we are going to discuss about the preparation of financial statement. First, discuss the meaning. Financial statement is the records that conveys the business activities and the financial performance of the company. Annual financial statement must be prepared by all entities except small proprietary companies. The annual financial statement consisting of balance sheet, profit and loss account, and profit and loss statements and cash flow statement. Components in a financial statement: balance sheet, income statement, cash flow statement, and equity statement. Let's we discuss in brief in upcoming slides. First one is a trading account. This is the first process in preparing the final accounts. Trading account is prepared for an accounting period to find the trading result of gross margin of a business. The amount of gross profit or loss the concern has made during the buying and selling during the accounting period. The difference between sales and cost of sales is an gross profit or a gross loss. The purpose of computing the cost of sales, the value of operating stock of finished goods, purchase, direct expenses on purchasing and the manufacturing are added, and the closing stock of finished goods is reduced. So then this is the format for trading account. It's a debit side and credit side. Debit side it consisting of a direct expenses. A credit side it consisting of direct income. Direct expenses means is nothing but the expenses occurred for the manufacturing the products. Direct income means that income should be generated through the sales. It is an direct sale. It direct in debit side it comes under opening stock, purchase, purchase return, wages, carriage inward, freight inwards, etc. This side it comes under the gross profit. This is a difference between debit and credit side. In credit side, sales return and closing stock. Next we move on to the topic of profit and loss account. This is a second step in the preparation of financial accounting. So the profit and loss is prepared to ascertain the net profit or net loss of the business by the business concern of an accounting period. Profit and loss account is an account into which all gains and losses are collected in order to ascertain the excess of gains over the losses and vice versa. So the profit and loss account starts with the gross profit brought down from the trading account on the credit side. All the indirect expenses are debited and all the revenue incomes are credited on the profit and loss account, and then the profit and loss is calculated. If the income or credit is more than the expenses or debit, the differences is net profit. On the other hand, if the expenses or debit side is more, the differences is net loss. Let's we discuss the specimen of profit and loss account. So first we forward coming brought forward the gross loss on the debit side. If the gross profit means brought down to the credit side. So these are all the examples for the indirect expenses that mentioned in the debit side. That means left side in the slide, and indirect income are mentioned in the right side. That means in a credit side. This is the profit and loss account specimens. Next we move on to the balance sheet. So balance sheet is the final process of preparing the financial statement. So balance sheet comprises of a list of asset and liabilities and capital funds on a given date. It represents the financial position of a concern as revealed by the accounting records. It reflects the asset earned by the concern and source of fund used in the acquisition of those assets. It is prepared in such a way to the true financial position relieved in from easily relatable and more rapidly understood the position of the company where we are in. The detailed information contained in the accounting records prepared during the currency of accounting period. The balance sheet may be called as a statement of equity, in which equity is established by representing the value of assets on one side and values of liability in another side, and the owner's fund also. The balance sheet or general balance sheet, it may be a general balance sheet, the statement of financial, or it may be on the condition in which asset and liabilities. The balance sheet is a classified summary of ledger balances remaining after closing all revenue items into the profit and loss account. So asset can be divided into four. It's some of the asset types. First one is a fixed assets. It's some example like land, building, plant and machinery, furnitures, etc. Fixed asset means it's permanently used by the organization. Next one is a current asset, the asset of the business in which form of cash, debtors, bank balances, bills, receivables, and stocks are called as a current asset. Next one is an tangible asset. Tangible is an physical shape, and as we can see, it's like an land, cash, stocks, etc. Intangible asset means it's there is no has a they don't have any physical shape. We can't see in that asset. For some example of intangible asset like goodwill, patents, trademarks, and licenses, etc. So then another one is an a liability. So liability gets majorly. It's a two types. It's an long term asset and short term asset. That long term liability and short term liability. Short term liability is called as an current liabilities. So long term liability is a repayable after a specific duration of long period of time. This is called as a long term liability. Then short term liability, that means a current liability means liability which payable during the operating cycle of a business. That means within a year, that is called as an uh, current liability. So this is a specimen of balance sheet. It's left side it's consisting of liability side, and right side is an asset. So these are all some example of asset and liability, that is capital, loans, that is an sundry creditors, outstanding expenses, it comes under the liability side. In asset side, goodwill, land, buildings, plant and machinery, furniture and fixtures, sundry debtors, receivables. So this is a asset. So thank you for watching the video.